I wanted to get the money in my hands, reinvest it, and then I could buy
Mm-hmm.
something else. And then in September, October, I'd buy it again. I did that for so many years. And then finally one day, I don't know why, I just looked it up and I found it says closed-end fund. I said, what is that? Let me look that up.
Mm-hmm.
And then I looked that up and I saw, wow, this is something. I was still trading individual stocks mostly
Mm-hmm.
until, oh, 2000 or before 2000, you know?
Welcome to the Expert in You podcast, the show for professional entrepreneurs, experts, authors, speakers, coaches, and consultants who are ready to elevate their business, expand their influence, and boost their bank accounts. Join us as we dive deep with industry leading experts who share their top strategies, invaluable insights, practical tips, and personal experiences to help you achieve extraordinary growth and success. Whether you're looking to sharpen your skills, stay ahead of the curve, or find that competitive edge, this podcast is your ultimate resource for unlocking your full potential. So tune in, get inspired, grab your coffee, and let's unlock the expert in you. Hi, everyone. Welcome back to another episode of Expert in You podcast. I'm your host, Carden, and I have an incredible guest with me today. And I'm really excited to share what he's doing because he's doing some things that are very different out there. He calls himself the retirement income coach. And I have Steve Selengut with me today. So, Steve, welcome to my show, first of all.
Thank you, Ann. Pleasure to be with you today.
Yeah, and I want to share now. You can't see this if you're listening to the podcast, but if you are seeing this on YouTube, I want to share his book here. It's called Retirement Money Secrets. And the thing I love about this is that, first of all, it's a financial insider's guide to income independence. But he says something on here that I love, and it's kind of his tagline. You can see it all over social media. Market value finds the ego, income fuels the yacht. So I love it. You know, it's going to be a great show. We're going to dive into what he is doing, really helping people build income through in their retirement. We're going to talk about some of the differences in what a lot of people have even learned about investing and funding their retirement to what Steve is doing today. And that was one of the reasons I really wanted to have him on the show so he could share the differences. But Steve, you've been at this retirement game a long time. You've been doing this about 45 years. Is that
Yeah,
right?
yeah. Yeah, even when right, retirement wasn't even something I would think about. I
Right.
had clients who were talking about it.
Mm-hmm.
So, and actually early on, even when I was doing my own investing, I was kind of an income focused guy, but not for the reasons you'd think. I was income focused because it seemed to me that if the stocks you were buying, if the companies you were investing in and becoming an owner of, were paying you a dividend, it was a good sign that they were profitable
Mm-hmm.
and that they had respect for you as someone who had given them their money and then backed them and so on. And it just seemed to me that if there was anything wrong, you'd find out about it first if they were to cut a dividend or something like that. So you'd know in advance before things got really bad, you know?
Right.
So so it was like a safety net. It was a way to determine the quality of the investment you were making. So
Yeah.
I never bought a company, even when I was younger, I never had a company that didn't pay me a dividend.
That's incredible. And one of the things I enjoyed when I was reading your book, of course, you know, kind of hearing your story and how someone gave you advice and you were just a kid at the time. You were a teenager. I'm 17 or something
Well, I
like
was a
that.
little older.
A little older than that.
Yeah,
And they
but
gave you advice to invest
yeah,
and you started doing that. And years later, that was you all of a sudden had this nice little amount of money that
right,
you had
right.
accumulated. So that kind of took you on that journey, so to speak, to get into that, dive into that a little bit more. So kind of just give us a little bit of your backstory, Steve, and share with my audience. Kind of,
Well, as you said, I was working, the usual type of work kids do and things
mm-hmm,
like that. And my father was in a business. He had a real estate business, which was very varied and very vertically integrated, meaning that he had a lot of things going on. Like he insured people who bought from him. He
mm-hmm,
loaned them the money, so he had different streams of income coming in. And he
mm,
always emphasized to that to us as a family, my brother and I, that these are the things you need. You need
Mm-hmm.
income. It doesn't matter if property's going up in value or if the rental house is higher. It doesn't matter. It's the people paying the rent that matter. That's the
Right.
important thing, the income coming in. So what I want you to do is invest part of your what you're making mowing lawns and whatever, and watch how it grows in a bank just from the interest that the savings account will pay you. And so I did. And then when I got this money, and I didn't get it in the form of money when I was 25, I got it in the form of stock certificates.
Mhm.
And they were all what we call blue chip stocks,
Right.
even now, but names like General Motors and
Mm-hmm.
GE and Sears Roebuck at that time was a pretty good name, and
Mm-hmm.
so on. And they all paid dividends. And I enjoyed that. And as you indicated, I got together with a broker who sort of took me under her wing, you would
Mm-hmm.
say. And she wasn't a salesman or a salesperson. Obviously not a salesman. She wasn't a salesperson. She seemed more interested in was like a teacher,
Mm-hmm.
and she said, you got to look at the price movements of these types of companies and the sectors they belong to and the market as a whole, how it flows. And since we have such a growing economy, it flows up and down, but the trend is upward. And you're invested in these companies that should move with the flow. And we started looking at it and came up with the idea, or I came up with the idea actually. Well, I'm looking at this I think it was Royal Dutch Petroleum, or before it was just Shell Oil, or vice versa. And I said, this one goes up to here and then it starts to come down again and up. And what if we were to sell it when it's in one of its higher movements, and then, whenever it goes back down again, we'll just buy it again. And we started doing that. And we started doing that with
Mm.
all of them. And then we started to find others that were in the same boat. They paid dividends, they were high quality companies, diversified operations, all these important things we put together and traded and traded and traded. And by the time I was 34 in 1979, I was making about 5 times what my employer was paying me in New York.
Oh, that's amazing.
So I just said goodbye. And I found two friends of mine, who were willing to let me start running some of their money. And
Uh-huh.
that's how it all began.
Yeah, that's incredible. One of the things that I hear was really the intention and the focus that you had to become really good at what you were doing. And how many people don't really put that kind of time or attention or focus into something to really move into, you truly are an expert. I mean, you've got the backstory for yourself, for your clients. I was so impressed when I was looking at a lot of the results that you have been able to get and just the things that you've been able to do in your career. So that just speaks volumes for you. There are a lot of people out there that teach that do investing, right? And a lot of people in the retirement space and in the financial space, but I was just so impressed with the things that you talked about and the way that you have done things. I mean, we've had investments for years, and I will I will just tell you, I'm not as impressed with them as I was with you. So we're probably going to have to talk.
Well, a lot of people today, if you were to ask them to look at their portfolios and tell you how much money they're making, not how much market value is growing and stuff like that, but how
Hmm.
much actual spendable money they're making,
Hmm.
either from dividends on their securities or on profit taking on those securities, you'd be surprised to see that it's usually 3% or less. And here we are in an environment where that same group of people that's managing your money, or that you're managing your money, that you have to be ready to pay to use 4% of your market value each year in retirement. That's the normal people are expected to spend.
Hmm.
Well, if you're only making 3% and you're going to be
Mm.
spend 4%, you're going
Hmm.
backwards. And if on
Right.
top of that 3%, out of that 3%, you're paying somebody to manage your money 1.5 or 2%,
Right.
then
Now
you're
it's,
then you're really going backwards, aren't you?
yes.
And the thing of it is that it's really easy to generate a lot more money than that in a portfolio, even without doing it the way I do. I mean,
Mm-hmm.
there are just dividend stocks that pay more than 4%.
Mm-hmm.
There are REITs that pay more percent. There are what they call business development corporations and things like that. And then, of course, there's the vehicle that I use, which is called closed-end funds. And they pay a phenomenal amount of income because of there's a great difference between them and all the others. And that is that they are trust vehicles and they have to pay out 95% of their earnings to their shareholders, which, was right up my alley, right? Because here I
Right.
am. I'm the guy that insists that they all pay dividends to respect my ownership. Now, these guys are giving me 95% of their earnings. So they're giving up growth of their own entity
Mm-hmm.
because they're paying out 95%. You just can't become an Amazon if you give away 95% of your income.
Right.
So it's a whole different kind of investment vehicle. It's a very old one, although most people haven't heard of it. It's very old. It's been around longer than mutual funds and 100 years longer than ETFs.
And I was
So
going to ask you too, Steve, how did you, so the closed-end funded securities, that really caught my interest in your book. And I was really looking into that. How did you kind of discover that? Because I haven't been aware of that, and which is why it really jumped out at me. So how did you kind of discover that?
I didn't discover it through any of the brokers that I
I
use.
figured. That's
But
why I asked. I'm
but
like, no.
along the way, I discovered uh, two securities, and I just was looking at dividend flow and things, and somehow I found a thing called petroleum and resources. And this was back in the time when energy companies were really very active and very volatile and
Mm-hmm.
very prone to combining with one another. There was a guy named T. Boone Pickens. Do you remember that name?
Mm-hmm. I do.
He
Mm-hmm.
was big in that era where he was, involved in a lot of these types of transactions. So this petroleum and resources company, I didn't know exactly what it was when I was buying it, but I did know that it was I thought it was a mutual fund that traded on the exchange, and it just contained all these different companies that would every year it would pay like 10 cents a quarter, and then in December it would pay like $10. So you'd be getting, 1 or 2% on the price, and then all of a sudden you get this enormous dividend at the end of the year. So I would wait until the dividend would hit, and then the price would go way up,
Mm-hmm.
and then I would sell the stock before I actually got the dividend because I didn't want to hold it again at that low percent. I
Mm-hmm.
wanted to get the money in my hands, reinvest it, and then I could buy
Mm.
something else. And then in September, October, I'd buy it again. I did that for so many years. And then finally one day, I don't know why, I just looked it up and I found it says closed-end fund. I said, what is that? Let me look that up.
Mm-hmm.
And then I looked that up and I saw, wow, this is something. I was still trading individual stocks mostly
Mm-hmm.
until, oh, 2000 or before 2000, And on the income side, as soon as I discovered those funds, well, let me wait a minute. Here's one that's an income one. What has it got in it? It's got bonds in it. And this one has preferred stocks. And then this one has government securities in it and treasury. Wow. I said, because if you've ever traded in bonds and things, you had to get you'd have to find some in inventory within the house you were dealing with. What do you guys have in your inventory? And well, we got these bonds and those bonds, and then you have to get a bid and an asked price because they weren't traded on the open market. You had to buy them at a premium or a discount, depending on where interest rates were, and
Mm-hmm.
you'd have to pay a markup. This is there's a lot of stories to do with bond trading, but I don't think we have time to get into all of them. But when you do this in a fund, even in a mutual fund, it's the same as far as this is concerned. But with
Mm-hmm.
these, you can trade them daily. You've got a whole portfolio of bonds, a diversified portfolio of bonds in the form of a common stock,
Mm.
and the yield was exponential. I'm not exponential. It was two or three times what you get normally. So it was a
Well,
whole
that's
new,
exponential if you do a
yeah,
comparison.
it is, but I didn't want to overplay it. It's so it was just a whole new way of looking at it. So I was
Mm,
converting all the old municipal bonds and corporate bonds and
hmm
individual selling the preferred stocks and so forth, and moving all the fixed income side of my portfolios, which was, I was getting into 80, $90 million under management at that time. So it was moving a
hmm
lot of money, and I had a lot of retirees, and this was a real boon for them, and their income was significantly increased. And then after 2000 or so, after the dot-com bubble, I started only buying the equities. And
hmm
then by the time we got to the financial crisis and all that, that was the end of equities for me because they didn't go back down again. From
Mm,
2009 on, it was pretty much up only until
hmm
2020 or so. It was just rarely had a correction. So the old parameters I used in buying stocks didn't apply anymore. I owned the same things. When I
hmm
buy a closed-end equity fund, I own Nvidia, I own Amazon, I own Microsoft, I own all the big names.
mm,
I own all the great blue chip stocks and everything else, and hundreds of them. So I've got this diversification plus income.
hmm
And I mean, that's two of the legs of the risk minimization stool.
Yeah.
You know, it was just a great way of looking at it, particularly when you're managing other people's money and they and you are both focused on income generation and not just market value focus is a great way to beat yourself up periodically.
hmm
You're in the market, you're happy it's going up, and then all
And
of a
then
sudden
it
it
goes
goes
down
down,
and you're not
and then
happy.
you're
And
the
yeah.
depths of despair.
Well,
Um,
and I want to dive into this a little bit too, because one of the things, especially when you are getting close to retirement and the money that you've accumulated and might have investments, you can't afford the risk. You can't afford to lose that money. You worked your whole life, right, to
right. Well,
to build that. And that is one of the scariest things, I think, for people that are in retirement or at least getting close to the retirement age. They know they're not going to be able to make that money back.
right. For most people, when the market goes down, it, even though it's just on paper, you only lose if you sell. But if you're in
Hmm
a position where you're getting close to retirement, you're planning on selling.
Right.
You're planning on using that to pay for things.
Correct. Hmm
So the thing that this brings to the table is you're going to have the same market movements. You're going to have the same up and down, but the income is going to stay the same. You know,
hmm
even if you take it all the way back to the basics, if it's a preferred stock or a bond, it doesn't matter what happens to the price. The contractual obligation is to pay the same amount of money. In
hmm
these things, in closed-end funds, they will pay the same amount of money. And if your portfolio is based on these things, it's actually a benefit periodically to have the market go down because your yield goes up.
Right.
And so you can buy more of the same things and reduce your cost and increase
hmm
your yield.
Yeah, and I really one of the things that just impressed me so much with your book and with everything that you're doing that I've just seen is so different from what a lot of people are out there doing is you really are income focused. And one of the things that stood out to me is you said, you don't have to sell things to pay the bills. You don't have to sell things to and love your life. Do you like to live the lifestyle that you want to live? You actually get to do that off of the income that you
Right.
make. And that's impressive because I don't think most people, when they're in that retirement age or they're in that stage getting close to that, would feel like I don't think they would feel like the security was there to be able to do that. So I would love for you to talk on that a little bit more.
I guess it's income independence. Like my wife and I were just looking at our September report from Fidelity where we have our accounts. And I was showing her because we go on a lot of trips. We travel a lot, like
All over the world. I already saw that. He's
all over the
everywhere.
world. And
And he does it on income.
we
Yes.
we have four or five more scheduled right now,
Mm-hmm.
assuming that we're going to be able to travel in in 26, actually, it's the latest ones we scheduled. But she gets nervous because it's expensive, and when you pay
Mm-hmm.
that all, and most of them get it in advance,
Right.
and when you have to pay the airfare and the trip fare, and we don't
Mm-hmm.
do it on our own, we do it with groups like Tauk
Mm-hmm.
and Viking and others. And I said to her, I said, well, come here and look at the numbers. And she looked at the numbers, and I said, we can afford to do all of them without invading capital. Does that make you
Mm-hmm.
happy? She said, yeah, I'll go book another. She didn't do that, but she said, yeah,
I'll go book another
that's
one.
yeah, but that's a relief,
Yeah.
and it's not to be, I'm not trying to impress anybody. I'm just saying this is a goal. It's an achievable
Mm-hmm.
goal for anyone if they get started early enough. Certainly if they have a great big job and, they're making a huge amount of money, it's a lot easier
Mm-hmm.
for them. But for anybody that puts their money away, some of their money away during their lifetime, and most educated or successful people, they understand this and they
Mm-hmm.
put some aside. They unfortunately don't. Most of them don't have time to watch it and to manage it on their own.
Or they
And
don't really know how to do that. I mean,
or
that's
they
almost a full-time job in itself, right?
it should be.
Yeah, to know
It
all the
can be a
ins and
full time.
outs and mm-hmm.
Yeah, but they need to know what to expect from the people they hire. And in my opinion, they should be demanding their advisors uh, make an effort to provide more income from the portfolio and to grow it with income, not to
Mm-hmm.
try to grow it with market value. And they have a difficulty doing that.
Mm-hmm.
And that's just part of the system, that the way the system works these days, the brokers aren't getting paid commissions like they used to.
Mm-hmm.
They're getting paid a management fee on the on unfortunately on the market value of the securities. I used to get
Right.
paid on market value, and when we had the correction in '87, and when we had the dot-com bubble and the Great
Mm-hmm.
Recession, I used to tell people, I said, look, your income's the same. It's not going to change. I'm going to be growing it for you now because I can do this, this, and this. And the good news is for you that my fee is going to be much lower now because the market value is much lower, so you don't have to pay me as much. And that was
Mm.
in, and I
That's
didn't get,
interesting.
so,
Yeah.
so that's the way I managed money. I don't see why other people can't do it that
Mm-hmm.
way, but most of them aren't in an environment where their bosses, where the companies are concerned as
Right.
much about income generation as they are about market value growth.
No, that's so true. One of the things that really stood out to me as well is you said neither a stock market correction nor rising interest rates, not even a pandemic, will have a negative impact on my portfolio income. In fact, any of these conditions will present me with opportunities to grow my income even faster. That is quite a powerful statement and one that would make people sit up and take notice, I believe.
I wrote it to do just that.
Yes.
And and it's hard, I think, for some people to accept that that's possible. And I'm not trying to make them feel like they're, you know, anything bad about it. It's just you don't, if you think about it and you said that would be nice, and then you say, is there a way I can actually do that?
Hmm.
And you ask somebody like me, and I say, oh yeah, it's not difficult. I'll show you how. Whereas if you go to some other people, they say, no, well, we don't have a model that will do that for you, or
Right.
something like that. That's the problem we have, you know?
Yeah. Think there's a lot of, I kind of hate to use the word cookie cutter financial
companies out there, financial advisors out there. Would that be a good way to say it,
Cookie cutter,
maybe?
one size fits all.
Yeah, that's it.
Set it
Yeah.
and forget it,
Mm-hmm.
you know?
Set it and forget it. That would be
Oh
a
my
better
God.
word. Oh, yes.
That makes my skin crawl when
I
people.
know that would be a better word. I mean, just everything you talked about just really spoke to me. So I want to know, and I know other people listening are going to want to know this. So, do you teach people how to do this on their own? Do you manage it for them, or do you coach them to do this? What is sort of your system or your process if people want to use Steve?
Well, the answer to the three questions is yes.
All
I
of it. Mm-hmm.
I show them, well, they read the book.
Mm-hmm.
I show them how they can do it themselves if they
Mm-hmm.
choose to. If they have the
Mm-hmm.
time to. They have somebody they can trust to do it for them. They can
Mm-hmm.
have somebody do that for them. I coach them. In the book, we talk about QDI. Remember that?
Mm-hmm.
Quality,
Yes. Yes.
diversification, income,
Income.
plus
Uh-huh.
plus PT, the profit technique. And I look at what they have now and what they've done. And a lot of them will be, they either have great diversification or it seems to me they
Mm-hmm.
have really bad diversification. And a lot of people have very large positions in very good companies, but still very large position. I mean, I had a guy the other day at $1 million in Berkshire Hathaway, which is a great, great company. It's been
Mm-hmm.
very good for everybody, but that was 20% of his portfolio,
Oh,
all on
yes.
one thing. Warren Buffett isn't going to live forever. And
Mm-hmm.
even if he's not managing it himself anymore, still it's his name on it, and
Right.
it's going to something's going to happen, or
Right.
somebody else is going to think differently and do a different thing. Who knows what's going to happen? But it doesn't pay any dividends. I mean, it's
Mm-hmm.
remarkably small dividend, which I can't believe for a guy like Buffett that would have a company that doesn't pay a big dividend since he's a value type guy.
Mm-hmm.
I have no problems with him at all. I think he's a phenomenal investor and he's always been a value investor like I've been. I teach them, I look at their portfolio and I try to tell them, I'll give them I'll even send them an instant email after I look at their portfolio and I see something like, you know, one position, 30% of a portfolio. I'll say, before we meet, maybe you should think about taking that down a little bit, stuff
Mm-hmm.
like, but yeah, we'll look at the ins and outs of everything they own. And then we talk about where they want to go with it, how much money they need. Can they do this decision making themselves? And some of them say yes. Most of them are confident that they can. And I have found that most people, once they make that transition, once they can change their mindset to focus on growing income, they can do it. And once
Mm-hmm.
they actually see the growing income and the growing working capital, they can become very enthusiastic about it and send you personal emails. Wow, I can't believe it. I did this, I did that, you know, and so that's yeah. And finally, the third part, if they want to do it, they can't do it themselves for whatever reason. I do have people that I can refer them to
Mm-hmm.
that do it my way.
That's great.
Hi, friend. I have an exciting announcement. I hope you're enjoying this episode of Expert in You podcast, but I have to ask you, have you checked out the latest issue of Expert in You magazine yet? It's jam-packed with rich content, powerful strategies, inspiring stories, and so much more to help you elevate your business and personal growth. Don't miss out. Go grab your digital copy now and join our community of experts making a difference every day. Go to expertinyoumagazine.com and check out your digital copy today. Transform your expertise into success with Expert in You magazine. It's not just a publication, it is a movement.
So, one of the things, just to kind of clarify for everyone listening, Steve is very income focused for retirement. That is his entire basically business model and his financial model. And again, a lot of financial investors or advisors, I should say, are not focused on income. And that is the one thing that sets him apart. And like we said earlier, he travels, he lives off of the income that he actually makes from his investments. He doesn't have to sell the investments. He doesn't have to liquidate those. to be able to have the lifestyle that he wants. And that is very different from what a lot of people are out there doing, or even the people that they're working with that are running their portfolios. Is that accurate, Steve?
Oh yeah, that's great. That perfectly describes the one of the two streams of income
Mm-hmm.
that I talk about in Secrets. And the other part of what I do is also quite a bit different. It's not buy and hold mentality. And I don't, when I say trading, I don't want you to think of trading as the four-letter word that everybody, oh, he's a trader. Oh, he trades. But this profit taking and trading are really two different things. You buy something that you'd be willing to hold for a long period of time because of the cash flow, the dividend flow you're getting from it. However, if it's kind enough to go up 3, 4, 5%, you're also willing to sell it, take the profit,
Mm-hmm.
reinvest it into some similar type of security, the same, in closed-end funds,
Mm-hmm.
and do that and over again. And you, in effect, you're compounding your earnings, just like you do by with interest in a bank. Every month you're getting
Right.
interest on last month's interest. Here, you're in addition to the dividends you're getting, the distributions you're getting a chunk of profit all at once. So
Mm-hmm.
let's say you have a portfolio that's earning 12% in distributions. That's 1% a month. And let's say one of those goes up 5%. You sell it, you're getting 5 months income in advance, and you're going to put
Mm.
that back to work in another closed-end fund for a similar
Mm-hmm.
amount of money. You do that 3 or 4 times a year, and you're making, the 10% flat and the
Mm-hmm.
15% on top of it. This year so far, my own for my own portfolios, I've made 6 months worth of distribution income in capital gains already.
That's amazing. One of the things you did say is that you can really show people how to 3 or 5 times their money. I think if I have those
Well,
numbers right,
3 to 5 times their income that
their
they're making.
income that they're right.
Takes years to multiply your money that long, even at these rates. But the thing is that you're not using any exotic or different type securities. All
Mm-hmm.
these are managed collections of the same securities you own right now. There's just ways that they do it to generate more income. And
Right.
and all of that is explained. How they do it is explained in the book.
Mm-hmm. And one of the things that I really kind of grabbed onto was when you talked about the old fashioned way, which was probably what I was kind of referring to earlier, the way a lot of people do the investments and things like that. You kind of call it the old fashioned way, the traditional way.
The traditional way.
Yes, the traditional way.
Right.
And it's almost like you've just sort of cracked a different code here, Steve. You
Well,
have figured out some secrets to investing and building income off of investments, and that most people aren't out there talking about or sharing,
right. That's
which
true.
is, which is
Yeah.
why you're on the show.
That's why you have me here, right?
That
So
is.
yeah, I've pretty much always done this, and I was fortunate. I had the initial broker experience I had was a great experience with this woman who really taught me all
Mm-hmm.
of the. She didn't go into all the technical details, and there are no codes or Z scores or strange, calculations. She says, just look at the charts, and you can see the cyclical nature of the market and of sectors. And once you appreciate they're going to go up and down and up and go down, it's just a matter of time before you figure out, well, it was here and now it's here. It may not be on the bottom, but it's certainly lower.
Mm-hmm.
So that's a better time to buy it than when it's up here. And if you do that, then as soon as it goes up a little bit, you say, well, it's going to go up. I don't know how long it's going to go up, but I know I've got a profit. I'm going to take that. If it keeps going up, fine. If it doesn't, so it just was a matter of time until I developed that into a system, and then I found a broker
Mm-hmm.
that was okay with me doing. He was. I've never been a broker, and I was called a registered investment advisor. And that means,
Mm-hmm.
what that means is you're registered by the SEC.
Mm-hmm.
So and you're very highly regulated, and you
Right.
have corporate compliance departments that are all over you. You literally cannot advertise. It's impossible to really advertise other than saying I'm Steve Selengut
Right.
and I'm a registered investment advisor. I can't say what my strategy is or what I've done or
Mm-hmm.
what I've accomplished. I mean, the red tape and stuff, it's really crazy. But anyway, he was willing to manage my money or let me manage my money with him my way. And I finally wound up even investing his money. So,
Interesting.
so I
You
turned
make
to,
it sound so predictable. I mean, you make it sound like the system that you've created is just so predictable, which we do not look at the stock market or investing
yeah,
that way, right?
it's not predictable. The only thing that's predictable is that it's going to be volatile.
Mhm.
The only thing is that you don't know.
Right,
You
right,
never know what's going to happen tomorrow. I mean,
right.
all kinds of illustrations. Look at things that go on in the world. You get a pandemic, you get a
Sure.
unexpected thing going on in lower Manhattan. Stuff happens that
Hmm.
affects the market. And it's, in my mind, it's like walking down the street and there's a $500 bill. There is no such thing as a $500. There's a $100
Hmm.
bill sitting there in the grass next to, as you're walking by, and you look at it and you look at it, you look around and there's nobody there. You don't see anybody frantically running back because he knows he lost it. And you pick it up and you take it. You go. You don't say, "Oh, $100? Nah,
Right,
it'll be $200 tomorrow. I'll come back tomorrow and get the $200." That's
right,
how people approach the stock market. They have $100 profit. They pass it up. Oh, it gets to be 200. Oh, wow, this is great. It's just going to keep going. I'm not going to take
right.
that profit. I'm not going to take it. Then finally, they come along, and here we have October 19th, 1987, and the market decides to drop by 30% in one day.
Hmm.
And all of a sudden, not only is that three, five, or $700 that he had there in profits missing, but this company that was so great is now down $700.
Right.
And he panics and he sells it and he loses his money. So this approach, the approach of taking reasonable profits, is a way to take that risk of the financial loss of an unrealized profit off the table.
This is so interesting.
What is that?
So
What is
before,
that? What is that plaque you have up there on the top of your?
who's who in America?
I have the same one right over there.
You do? Yeah.
Absolutely.
Yeah, that was a couple years ago. Who's Who in America for entrepreneurship and also for professional women. So,
Yeah. Well,
mhm.
I didn't get it for professional women,
Yeah.
but I got it. I got it.
Yeah, so you recognized
I
it. Well,
did. Yeah.
cool.
I thought,
Hey,
hey,
to
we're
a
buds.
fellow Who's Who. Yes,
Right.
that's awesome. That's awesome.
You're the
So,
first person I've ever seen with that.
yeah, I've had that for a
Yeah.
couple of years. Yeah.
Cool.
So, yeah, that's cool. So I want to dive into before we kind of wrap things up and pull everything together. This has been so interesting. I know my listeners are going to find this so interesting as well. You talk about the six basic principles of income focused retirement investing. Do you want to just kind of hit on those really quick and kind of share what?
Yeah.
And I know you talked about a couple of them already,
We
but do you want to kind of go through those?
we've mostly done that.
Mhm.
Um, but one thing before, I just want to, you know, this is a management type program, and it takes time and it takes
Mhm.
study. It's not as easy as you and I are making it sound. It takes some
Well,
effort. You
kind of like
can't just
building a business.
you can't just drop in.
Yeah.
It becomes your business. I
Mhm.
think of it as my department store where I own a lot of stuff.
Yeah.
I have a profit
Hmm.
margin that I want to get, and somebody offers me that, I sell it, and I put something else on my shelf. I'm not
Mm.
waiting. No entrepreneur wants to see the value of their inventory go up.
Right.
They want
Right.
to they want to sell. They want to see their bottom line profit and income
Hmm.
go up. And
Yeah.
that's the way I do it. The six basic principles which apply to any kind of investing, whether you're doing closed-end funds or anything else,
Mm-hmm.
and we have touched on them. The basic four risk minimizers, the understanding the quality of everything
Mm-hmm.
you buy. For example, it's got to be a stock that pays a dividend. It's got to have been
Mm-hmm.
in business a while. It has to have multiple products. Income production.
Mm-hmm.
For me, it has to also produce income for you. Diversification. You have to have a wide variety of sectors, of types of companies, even of locations around the world, because we are, after all, a world economy.
Mm-hmm.
So that's diversification. Profit taking, we talked of. That's the
Right.
way the higher the market goes, the more risk there is that it's going to go down.
Mm-hmm.
And when you're in that type of environment, you take your profits and that minimizes that kind of risk.
Right.
Okay. So those are the four basic elements. Then the two other ones, we talked about how the market is cyclical.
Mm-hmm.
That's one. Understanding that the
Mm-hmm.
market is cyclical, that sectors of the market, securities are all cyclical in their own way. And understanding where you are in the cycles will tell you if the stock market is like at an all-time high it is now, you can
Mm-hmm.
still buy the stocks or the closed-end funds you want to buy that are invested in stocks. Just don't buy as much of it because
Mm-hmm.
eventually it's going to go down and you want to be able to buy more of it at a lower price later, you know,
Right.
and to take advantage of the down movement, you know. So when everything is down, you can buy your everybody should buy things. They don't want to get to be 5% in anything, so they want to buy a certain percentage when they start so that
Mm-hmm.
they can buy more when it goes down further. So they got to understand that it's always going to be a cycle. There's never
Right.
going to be a rally that's not followed by a correction ever. Interest
Yes.
rates are going to go down a little bit more again. Eventually, they're going to go up again.
Right.
And right now, we're at just under 5% interest rate, and
Mm-hmm.
people are thinking that we're still at high interest rates. People my age, 5% used to be the low end of
Right.
the stick. I mean, I remember interest
Mm-hmm.
rates 12 and 13%.
I can
I,
remember that too.
I,
Yes.
I remember buying a New York Port Authority municipal bond that was yielding 12% tax free. Come on.
Wow.
So we're still at very low interest rates. They're probably going to go even lower right now.
Mm-hmm.
So that's, the cycles. There are cycles in everything, or economic
Mm-hmm.
cycles, but those are the two major ones, interest rates and the market. And then the final one is this mindset, the mindset of income focus versus
Mm-hmm.
market value focus. And if you're income focused, you think about it, if you're making 8% on your money, something like that, and you're reinvesting that, and you're taking a reasonable amount of profits periodically, and let's say you can get to the point where you're making roughly between 8 and 10% average in
Mm-hmm.
physical hard earned dollars that you can reinvest. You build up your floor, and that floor, that way you produce more income next year. You don't know how many profits you're going to get, but the income is going to keep growing.
Mm-hmm.
And some years you're going to have great profits, like 21, where we doubled our distributions with profits. You
Right.
know, that's going to happen. But you're going to build your market value too. When
Right.
when the stock market is as high as it gets, and the bond market and interest rates are as low as they get, you're going to be at an all-time high in market value too. But those two forces, interest rates and the stock market, don't always go in the same direction.
So when is it too late for people to work with you, Steve, to, they're already older. What's sort of the age range? We know that obviously doing this at a young age is smarter and all of that, but when
It's
is it too late for people?
I don't think it's ever too late if you have assets, even if you're my age, if you're
Mm-hmm.
almost 80 or over 80, if you have a couple $1 million sitting there and you're sitting in CDs, or it's in a bunch of stocks, which it really shouldn't be at that age, but it well
Mm-hmm.
could be, that's not paying in any income. An easy thing to sell the securities you own and purchase securities that are paying more income. That's easy. It's easy to, and it's
Hmm.
easy to program that even so that it'll be, most people get very hung up on the taxes involved in taking the profits on those things that they've loved forever. Yeah. But that happens, and you only pay the taxes once and the income will keep flowing.
I was going to ask you too, from a tax standpoint. So when you're taking the income, how is that taxed, or what happens there?
Well, it's just like a normal profit, and dividend and
Hmm.
distribution income are all taxed as investment income.
Hmm.
And our tax code is not that friendly to capital gains,
Right.
especially short-term capital gains. But, you
We
know,
don't even want to talk about where that might go too.
yeah, it may or may not. We don't know.
Yeah.
But even, it's just like this. If your boss came into your office and said to you, Ann, you have done so well this year. You probably your own boss, so this isn't going to happen. But let's say someone's boss comes into their office and says, you've done a really good job for us this year, and I'm going to give you $100,000 bonus for your year-end efforts. There isn't one person listening here would say, "Oh no, you're not. I'm not paying the taxes on that."
Right.
You're going to take it. And even if
Right.
you wind up with just $50,000 because you are, a gazillionaire, and
Right.
I don't even think we have a 50% tax bracket, do we? I've never been there. You're still way ahead of where you were without that additional money. So,
Right.
you
Yeah.
you can cry all the way to your accountant's office, but I'm not
Yeah.
going to pay any attention to you. I'm happy to pay I am happy to pay too much in taxes.
Like when you, yeah, like when you win the lottery, right? And they take half of it or 55% of
Right.
it, I
Yeah. How
think.
bad
Yeah,
is
yeah.
that? Yeah. You only got 1 billion instead of 2 billion.
Yeah. So good. This has been such a great
Hmm.
conversation. What is there something that you would like to share that we haven't hit on, or that you would like to just kind of say in wrapping everything up?
Well, when you go through those 6 things, and if you've learned enough, and then if you've got the evidence to support the idea that you should focus on income instead of market value, and you see the market cycle, you start looking at it and say, oh yeah, that's what's happening here. This
Mm-hmm.
isn't going to go on forever. We're going to have another correction. you know I think you've got most of the secrets of a successful investing, and then it's just a matter of the details, the process. How much of it do I buy? How do I know one
Right.
from the other? Why, if you got, Steve, you have 100 different income closed-end funds. I can't buy 100 of them. How many, which ones should I buy? How do I make those
Mm-hmm.
determinations? Those are the things that you have to get into more detail about. And I try the best I can to get into it, but everybody's going to look at it a little bit differently.
Mm-hmm.
And everybody's timing is going to be a little bit different. Like right
Right.
now, it's foolish to buy stocks at their highest prices in the history of mankind. Really, some of them,
Right.
highest they've ever
Right.
been.
Mm-hmm.
Closed-end funds, some of them are the highest they've ever been. You don't, if you do buy them, you don't want to buy nearly as much. And you never want it, and you always want to know your QDI, quality diversification income,
Mm-hmm.
so that you don't get tricked or panicked into selling the ones you own because you've already vetted them. They're fine when they go
Mm-hmm.
down in price. There's a good day. Every day on the market's a good day. It's
Yeah.
either a
You
good day
make
to
it sound
buy or a
you
good day
make
to
it sound
or a
easy,
good day to
Steve.
sell.
You
It's
make it sound so easy.
I've been doing this for 50 years.
I know, and you don't even
So
understand the value that you bring, right? It's
right.
yeah, it's so second nature to you. It's so easy for
Yeah.
you. This has been such a great conversation, though. I really enjoyed it. And Steve, how if someone wants to work with you and you're going to be coaching them, what would that look like for them? What's the sort of your traditional model for coaching someone in this?
We get together and we did do what we talked about here.
Mm-hmm.
We discuss what you've got now, what's it look like? Are you in danger? If the market
Mm-hmm.
were to crash tomorrow, are you going to get burned?
Right.
And we try to fix that immediately if there is something, you know, and we talk about all those aspects. And then any number of questions they'll have, everybody has questions.
Right.
At one stage, there's something that everybody's scratching their head about. So we discuss all those questions, and I try to learn things about the people I'm talking to, and then and then we set up a plan,
Mm-hmm.
and it's like a homework assignment. I said, I think we're going to have to meet again. This is what I want you to do over the next few weeks, and we'll meet in a month if that's okay. And or otherwise say, well, we've discussed all this. You seem to have a feel for it. You call me if you think you want to meet again, because
Mm-hmm.
I don't think I think you actually got it. I think you know it. A lot of
Mm-hmm.
people who read the book and come to me, it's really just for confirmation
Right.
of what they've
Okay.
done. It seems that way. And there's some people who want, some people have large, complicated situations, and
Right.
some of them, very few actually, do retainer agreements where they hire me for a year, 10,
Mm-hmm.
10 meetings. I haven't found those meetings are becoming 15 and 30 minutes instead of an hour, because we
Mm.
just really talk about, I say to them, boy, I'd like to, show me your profits for the month, something like
Yeah.
that, because that's where we are now. We're now buds. We're doing the same
Yes.
thing. And you just want to,
Yeah.
compare. And if I happen to see something that he's done or not done, like,
Mm-hmm.
why haven't you sold that one? He
Mm-hmm.
says, I really, really like, I said, you can't fall in love, man. You know,
It's like a
you're not
business.
going
Your
to
baby
marry
has to
these
grow
things.
up.
You,
That's
you
right. You
know,
have to be willing to let go.
yeah, you do, so,
Yeah.
so that type of, we get back together, we talk,
Mm-hmm.
you know, uh, so yeah,
Yeah.
so
So
that's what it's
good.
like. So we go through all that and we set up this plan. And if they accomplish the plan, they tell me, and they want to talk again, they don't want to talk again. I follow up, I send out, I have a mailing list, of course, and I send things out, and then they might say,
Mm-hmm.
might jog their interest and they want to get back together again or something like that. So,
Yeah.
but it's easy. It's really a good, it's a conversation, just like the book.
Awesome. This has been great. So we're going to put all of Steve's links in the show notes so you'll be able to reach out to him, contact him. You are on LinkedIn, Steve. Are you pretty active on LinkedIn,
Not
or is reaching you through your website?
I post my podcast there.
Okay.
I post,
Okay.
if I ever write articles. I don't write. I have a ton of articles on LinkedIn, but I haven't been
Hmm.
writing articles recently.
Okay.
But they're interesting, I guess. But
Yeah.
so
Okay.
yeah, I'm there.
All right. And well, and we'll put his website and everything else so you can definitely get in touch with him. Go grab his book. It is exceptional, and I'm going to dig into it even more. And actually, probably I'm going to buy my son a copy as well because I know he will probably love this. I'm getting ready to see him. I'm going to take this to him. I don't know if he'll get through it in the time I'm going to be seeing him, but
Okay.
anyway, so this has been great. So reach out to Steve. You can clearly hear that he knows what he's doing. He is not the traditional financial person out there. I've talked to so many of them, and that was one of the things that just really grabbed me and grabbed my attention about what he is doing. So thank you, Steve, so much for being here.
Thank you for having me. It was a great conversation. Enjoyed it.
It was a lot of fun. All right, everyone. When if you will share this out and get this out into the world, and make sure you subscribe to the Expert in You podcast. We really appreciate that. We want people to hear the experts that I have on the show, and we're trying to really build the show's reach. So we always appreciate that. Let us know what you think of these episodes, and if there's something that you would love or someone that you would love for me to interview on this show, please reach out to me and let me know that as well. So until next time, go rock your business, and God bless you all. Have an amazing day. Bye bye.
Thank you for tuning in today. If you're as excited as I am about scaling up your influence, business, and bank account, then I have just the thing for you. But first, make sure you subscribe to the show. Second, make sure you share it with someone you care about, because sharing is caring. And third, head on over to join me in my next free virtual exclusive workshop, where we'll explore proven strategies to boost your business and maximize your potential. Look, it doesn't matter if you're just starting out or if you're looking to take your business to the next level, my workshops are designed for you. So head on over to expertinyouworkshop.com to reserve your spot and get ready to transform your expertise into extraordinary success. I'm looking forward to seeing you there and helping you achieve incredible growth. Until next time, make sure you're always seeking the expert in you, and God bless. Have an amazing day.